Thank you all for coming back to us. I'm very excited for our next session on ESG investing. And when I think back to our opening session, really Penny's comments about what's good for society is good for business. I think one of the main tools that we think about in this industry to express those what's good for society is oftentimes through ESG investing. And our next panel will take a look at that idea and see how well it actually holds up in practice. Now, during today's session, the panel will discuss the stated value proposition of ESG and strategies that accomplish this, including some segmentation. We'll also talk about the themes of critique of ESG. What is and is not legitimate? And lastly, think about where do we go from here in the ESG world? What do we follow through? How do we follow through with these critiques? Now, leading that conversation is Peter Baumgarten, Koch Family Professor of Practice and Family Enterprise, Director of the Koch Family Center for Family Enterprise here at Washington University. Now, he'll be in conversation with Jessica Huang, Director, Head of Americas and APAC Platform Strategy and Innovation on the BlackRock Sustainable Investing Team, as well as Emily Chu, Executive Vice President and Chief Responsible Investment Officer for Calvert Research and Management. Peter, Emily, Jessica, very nice to have you all today. Please take it away.
Wonderful. Thank you, Ed. Always appreciate the opportunity to spend time with this group. I will say that this is one of the topics when I tell people that I'm moderating, they have the most interest in. So when I tell people I'm teaching talent analytics or a class on family business, there's a lot less ears being perked up. But as soon as I start to talk about the fact that I'll be spending time with our two guests here today, Jessica and Emily, focused on ESG investment, I think there's quite a bit of interest. And so my hope is that for today, we're able to cut through some of the lack of clarity around this space. We're able to zero in a little around what the debate is actually about, and then hear what this might imply for the future of the space. Just personally, for me, I'm very interested in this in my work on the family enterprise side, because I have private companies thinking heavily about how they think about these activities. And then also on the family office side, the same thing, people thinking about how they translate a set of values into investment strategies and what the potential return implications as well as impact on the market would be. In another world that I play in, I lead a class of 70 freshmen at WashU when they're thinking about the overlap between morality and markets, using novels to be able to illustrate these types of dilemmas. And I can tell you that the next generation is thinking quite a bit about these issues as well. So again, I appreciate Jessica and Emily joining us for today's conversation. All right. So with that said, what I want to get us started with is just a few quick introductions. And the bios and vitas of both of these individuals are quite long, so we're going to keep it relatively tight here. But in particular, I'm curious actually who you are, what organization you represent, and then more importantly, how you're involved in this world of ESG more broadly. So Emily, why don't we open that up to you first, and then we will turn it over to Jessica shortly afterwards.
Thanks, Peter. And it's so great to be here today. And I'd love to be a fly on the wall with some of the discussions you have with your students and community about this topic. So I'm Emily Chu. I'm the Chief Responsible Investment Officer of Calvert Research and Management. Calvert has a 40-plus year history in the responsible and sustainable investing space. We're one of the original industry pioneers. With the launch of one of the first U.S. mutual funds back in 1982 that screened out South African stocks because of the founders' belief about the legitimacy of the apartheid regime at that time. And obviously, over the last 4 decades, the space has become quite nuanced, complex, sophisticated, and we have grown with that space over time. We now run around 40 or so mutual funds in the US, all with a consistent approach to responsible investing embedded in these strategies.
Great. And maybe just one clarification question here, Emily, and then we'll turn it over to Jessica here in a second. When you say consistent approach, in a short bit, we're going to be talking about different segments and ways to think about this. What's consistent across those 40 different products versus what's differentiated or changing?
Sure. What's consistent is the underlying conviction in the materiality of ESG factors over the long term. And on our website, we actually have a set of principles for responsible investment that actually list out what are the ESG, what are the responsible business behaviors in the category of environmental, social, and governance that we look for. And so what we do is research all of the companies that we invest in from an ESG lens, create an investable universe or pool of assets out of that research, and then all of our strategies use that same investment universe. What's different is that once you've got that universe, you can actually create different types of asset class or investment styles to give investors the exposures that they're wanting from a financial perspective. So you can have a fairly concentrated fundamental equity strategy. You can also do an equities index strategy. You can also do a thematic green bond strategy, for example. So you've got the foundation for consistent philosophy on ESG factors. And then from there, you can actually serve a broad range of needs in the investment space.
Great. And we're going to talk a little bit about segmentation later on, who this is a fit for and what formulations, amongst other things. So nice start of our discussion there. Jessica, same question for you. Both you, your current role, and then more broadly, how your role overlaps with this broad universe.
Great. Can everybody hear me okay?
Sound great?
Awesome. So thanks so much for having me here today. So I'm Jessica Huang, and actually as of yesterday, I've taken on a new role at BlackRock. I am now the Global Head of Sustainable and Transition Product Integrity within our central global product function. So in this role, I really focus on setting and maintaining the standards for our sustainable products across the globe, partner really closely with all the investment functions across index, active, alts, the various asset classes to really use these standards to accelerate the product innovation. And at BlackRock, our sustainable platform spans across 600 billion of assets. Happy to talk about the different approaches, the different spectrums of solutions. And prior to taking on this role, I really headed up different pillars within our central sustainable investing team, focusing primarily on commercializing sustainable strategies and innovating on sustainable strategies.
Great. Jessica, so one follow-up question on your role in particular. So imagine you just start with this new role, you go and you grab dinner with some friends and they say, product integrity, what exactly is this in the context of what you do? So how would you determine what is a lack of integrity in a product or integrity in the things that you're looking at?
Honestly, in this space, so much of it is really about just transparency, right? Because, we'll talk about this more, but in the sustainable investing space, clients and investors come at it with very different motivations. And so products serve the needs of so many different objectives. And one product can fit the needs of multiple clients. Some products fit the needs of very specific clients. And so at the end of the day, the most important thing is being very transparent about what these products are doing. Right. It's very important to be clear in the naming, in the disclosures, how you're designing these strategies, how you're using ESG data, how you're reporting on ESG data. And so when I think about integrity, it's really about that. It's about setting the standards of how we disclose, of how we build these products, how we name these products, and how we market even.
Okay, great. With the idea that in that transparency, there can be a better link between any particular individual and their choices downstream in terms of how they want to invest.
Exactly.
Okay. Great. All right. So I want to kind of dig into a bit of the philosophy. So you heard this teed up from Ed. We're going to spend a little time talking about the philosophy behind this, the current value proposition. We're going to spend a good bit of time on critiques because there's a lot of critiques that are in the media more broadly. And then finally, what this might imply downstream for the evolution of this space. But let's just get our head around the current space here. And I was struck in our conversation earlier on, I guess last week when we were prepping for this, that there's an underlying question of what exactly is this? So, for example, is it about the data? Is it about decision-making? Is it about a set of particular convictions? For example, as we talked about apartheid in South Africa, put onto a set of products. So what I'd love to do is to just step back to make sure that we're kind of thinking about the space more holistically and with clarity, to think about how you would define ESG in its current formulation. And I know that's a really big topic. So again, we could spend probably the next 2 hours spending time on this one. But I want to be, again, tight to this point. Let's just get our heads around and our arms around this particular space. So maybe, Emily, if you don't mind kind of kicking us off there, you talked a little bit about this idea of data and decision-making and then also products downstream. How do you think about it in this current state?
Yeah, thanks, Peter. So I think it's always important to have this level setting discussion before you have an hour-long panel in this space, because I think terms are important. They're important, but in some ways they're kind of representing a bigger movement, and they're maybe less important than the movement itself. So ESG is used in practice, it's an acronym, means environmental, social, and corporate governance. But in practice, it's used as equivalent to other terms like sustainable, responsible, and sometimes even ethical investing, sometimes green. And basically, all these terms have slightly different nuances on what they might be getting at. And sometimes that depends on who you're speaking to, what that term means. But I'd say broadly, if you kind of zoom out, they're all referring to this move that we see in financial markets from the implicit to the explicit recognition that companies operate in and they rely upon a broader environmental and social context, and that this context is relevant to investors, and that traditional financial metrics, while they have been extremely useful, and they're the foundation of everything we do today in the investment industry, the traditional financial accounting standards and metrics that we've been using are not adequate for fully giving transparency into how that company relates to its context, its environmental resources it relies on, the human capital resources it relies on, the customers and communities that it interacts with. So this is broadly, you can call it sustainable, you can call it responsible, ethical, whatever. So to me, the term ESG itself is not an investment philosophy. It's not a complete belief system. It's not a view on the markets. It's really just an acronym that helps us organize this messy world of context for companies into categories of data that you can then use to drive analytics. It allows you to benchmark companies in a particular topic or area of behavior. It allows you to run kind of regressions, ideally where you've got enough data around the correlation between some of these factors and financial metrics. But I think the term ESG investing or an ESG fund has kind of taken off, and it's kind of mixing up this concept of the data with the decision-making process and then the product labeling. So, when I say that we're moving from this implicit to explicit recognition of companies operating in context, when it comes to actual use of the data in a process, that can take many forms. Once you've got the data, you can do lots of things with it. So, for example, you can use it in a fairly binary screening approach. You can screen companies out or you can screen companies in, set some threshold, for example, exposure to tobacco or a track record of human rights violations or the level of ambition of a carbon target. And you can use that to set a threshold that sets a binary in or out function for an investment universe or for a product. And that's controversial for some people, but it's actually quite common as a use today, often driven by clients and their preferences. And often the values-based investing discussion that's around what I believe and what I think is right, ethically or morally right, tends to be expressed in this form, in a binary function. But you can also use this data to do bottom-up research, to identify what is the impact of financially material ESG issues on potential valuations. So what's the impact of a product safety recall record on a pharma company's provisioning for penalties and its balance sheet? Or what's the kind of assumed costs or estimated cost of recruiting and retraining for an auto manufacturer that has a very high turnover rate compared to other industry peers? So, as investors, I would say, in closing for this introductory comment, I would say that as investors, we're concerned about the future. We are inherently making choices about what we think will happen and not happen in the economy and in society and how that affects the companies we invest in, their asset base and their cash flows. And it's your investment philosophy that defines your view about the future. And that is what defines how you use this ESG data.
Okay. So maybe just one quick follow-up point, and then let's see if we can continue to dig into this a little bit further. So you said that the context is relevant to the investors. 100% agree on this. Is the context especially relevant when it comes to value alignment, or is the context relevant to performance or some combination of the two? So for example, I might not want to invest in South African companies back in the day for particular values-based reasons. I might not also want to invest in it because I think there's a certain kind of risk of companies operating in this space that has performance implications. When you think about kind of those two, is it driven by one versus the other? Is it an equal mix of this value alignment as well as performance implications? How do you conceive of that?
Thanks, Peter. It's a great question. I'd love to hear Jessica's view on this too. I think when we speak to clients, we say, well, are you doing this? Are you asking for this screen or for this exclusion, say, of companies with no carbon targets or whatever it is? Are you doing that because it's your value that's your belief that you just you don't think that's correct behavior for the economy, because maybe you have an intergenerational justice perspective to your portfolio, which may be, meant to be set up for in perpetuity? Or are you doing this because you're really concerned about the risk of stranded assets, and these companies are asleep at the wheel in an era of rapidly changing climate? Now, obviously, ultimately, it's a spectrum. It's not this binary. You're either on the value side or the value side. In many times, we've seen examples where some form of behavior that you would think is maybe not ethical spills over into a headline risk for a company that has an impact on value. We saw that recently with a large fashion house that made some poor choices around its advertising campaign. And you could say, well, that's a governance issue. Well, it's an ethics issue. They shouldn't be kind of mildly referring to child pornography in the way that they are, kind of that's implicit in that advertising campaign. But then and you could say, I don't want to be involved with companies that have, that kind of moral orientation, but it spills over into the valuation when the majority of the value of the company is in the intangible assets. It's in the brand value. So we see this spill over all the time. So I think it's not always an easy question to figure out where is that line. And it depends on the issue, the geography, and the context of the company oftentimes.
Yeah. So Jessica, let's stay with that same theme then, because I think it's kind of related to this broader sense. There's the value, there's the values. You're in the business now of finding ways to be as integrity oriented with the way that you communicate what's actually involved in it. Is that clear context, transparency around context, intended to drive the value side, some combination of the two? How do you conceive of it?
Yeah, no, I mean, everything Emily has said, I feel like I've just been nodding my head vigorously. So I think you're going to be hearing a lot of the same, but kind of going back to the foundational question of what is ESG, right? ESG is really that data set. It's a toolkit. It's just information that's grouped into those buckets. And that data can be used in different ways. And that is the motivation of the investor, how they want to use it. And this is the same thing on the client side. They're choosing products based off a specific goal and motivation. And it could be varied. They could have multiple goals, multiple motivations. But really, the data is used to either enhance returns and or to align with values. And I would say even a step beyond just aligning with values, sometimes it's to actually help contribute towards sustainable outcomes. Right? A lot of times we talk about values, it's about screening, but for some clients, they actually want to have a real world impact. And that can be also a different type of motivation that leads to different types of products or solutions that they would invest in. And so when we think about designing products, we just need to be very clear in terms of what is the intent of the strategy, right? Is this strategy designed just to screen? Is this strategy designed to actually contribute towards a sustainable outcome? Is this strategy just integrating material ESG considerations, in which case we're not even branding it as a sustainable strategy because there is no goal of actually greening the portfolio. The portfolio's only goal is just a financial return, right? This is where if ESG data is material, it doesn't really matter what data set you're looking at, ESG or not. As an investor, you're trying to find the most important data to help inform your investment decision-making. And that's where ESG can be helpful. But the goal of ESG incorporation or ESG integration is not to actually make your portfolio more ESG or more green. It's just to enhance your returns. And I think that's something that just needs to be very clear, that there are going to be sustainable products on the hand that do have ESG as sort of the principal means of selecting investments. And there you're meaningfully binding yourself to something using ESG data and ESG information. And so I think being very clear about that is really, what we try to do at BlackRock.
Yeah, I love that. So let me see if I can kind of frame a bit of a follow-up question to the two of you on this. So I love the data side, right? I mean, this is me speaking as a social scientist. I love kind of knowing that information. I love running regressions, just as we talked about earlier. So I'm curious what we've learned over the last little bit about kind of two categories of performance or implications. One is, as you just mentioned there a bit ago, Jessica, the implications on actual company performance. company behavior, not even performance. So how companies behave in response to the products. And then another one is actually specific to investor performance. So what have we learned broadly about those two broad categories over the course of your times respectively playing in this space? And we'll kind of open it up to whoever wants to start on that question, both implications on companies behaving a certain way around ESG, particular measures or metrics or behaviors, as well as what we've learned around portfolio performance for those that have a meaningful role in this particular strategy.
Sure, happy to start, and Emily, feel free to jump in. I do think a few things, right? And I feel like we're probably going to take the conversation in so many different ways here, but a big thing that's changed a lot in this space is that because there is more demand, right, for sustainable investments, because there's more demand for sustainable data, the landscape of sustainable investing and ESG data is just totally different now. So when you think about company behavior, now hard to say if company behavior is really changing as much as we're getting more data. At least now we actually know how to measure company behavior, company performance. Mm-hmm. And so one of the stats that people always throw out in the space is when you look at the S&P 500 today, right? Over 90% of companies now are reporting on some form of sustainability data metric, something. Mm-hmm. 10 years ago, that number was about 20%. So clearly in the past decade, corporates are starting to realize investors are paying attention to this. So I actually have to provide this information. And I'm sure we can spend an hour just talking about the data evolution in the space. Now that we have this data, it doesn't mean that it's the best data, that it's standardized data, that it's comparable data, but we have more data now. So I think the most important thing that we're seeing right now from a corporate side is that disclosure is becoming front and center in terms of how they're thinking about it.
And let me pause you there for 1 second. So that's a really good point, right? So imagine layers of behavior. One piece of it is saying greater amount of disclosure with the idea that this would be correlated likely or related to some degree to behavior itself downstream.
Exactly.
At the very least, we can measure.
Exactly. Yeah. Exactly. And that's what people say, right? Like you have to start with the measurement first to even know how to benchmark your performance to then actually improve. And I think what we're seeing now is that you start with the measurement, and now companies are setting goals and targets. It could be diversity-related targets. And now we're seeing a lot of climate-related targets, right? Companies are signing up for science-based targets. Companies are setting net zero targets, but you can't really set goals and objectives if you haven't actually measured where you are today. And it starts with that. So I think that's like a big change. So not to say that companies are more responsible today or will definitely become more responsible, but with the data, we can measure that. And generally, if you're releasing that information, there's going to be a lot more pressure for you to want to actually do well on that data set that you're releasing to investors. I probably said a lot, but
that's good. Well, why don't we kind of then? Yeah, please do.
Let's talk about, and then we get onto the investor.
Good, I love it. Yeah,
they're two big kind of parallel different topics, but I think Jessica, what you've contributed is important. What we've seen at Calvert is, definitely that more data. What we see is we ask for companies all the time for better and improved disclosure on all kinds of topics. So, for example, what is your climate transition plan? We see some target, but we don't know what you're doing to actually meet the target. And we want to see the capital allocation plan that goes straight back to the financials about whether these are realistic targets or not for you, company. Or we've run a campaign where we've approached the top 100 holdings in the US, asking them for more complete diversity disclosures, asking them for disclosure that we know they have to make to the Equal Employment Opportunities Commission, the EEOC. They're mandatory required to disclose to the EEOC, but not required to make it public to investors. And we have such high conviction about the materiality of having a diverse workforce and a diverse leadership team to be able to be innovative, competitive, and well risk managed in the current environment, that we think that's important for us to have. So we went out and asked the companies for it, and we found many companies are very willing to hand it over and to make it public, but there were some holdouts. There were some companies that didn't want to disclose it. And why? Because it didn't look that great. And so certainly there is like a disinfectant or a sunlight. Sunlight is the greatest disinfectant factor, I think, for companies in disclosing. The act of actually having to disclose, it focuses management attention on the issue. you're often having to create as a company for the first time reporting pathways and data tracking systems for a topic or an issue of interest that focuses management time and resources and attention on it. And then what we see over time is that companies, once they've got the data, they start to factor it into their business planning as well, which is exactly, I think, the intention of these engagements with companies. I just wanted to highlight that I came across a summary of a paper that was published last year in the Review of Accounting Studies journal, which looked at the reporting of greenhouse gas emissions among companies in the UK. So the UK is one of the earliest jurisdictions that has made GHG emissions reporting mandatory. And what the authors of that article found was that the reporting requirement actually led to an 8% decrease in emissions by UK firms compared to another group of companies that was not affected by the regulation. So the fact of having to disclose, again, it caused management to pay attention. It caused management to look for efficiencies, not only for reputational issues, because everyone wants to disclose a good number, but also because it gets them thinking about operational efficiencies in their business.
Yep. So that's a really helpful framing. So let's see if we can kind of marry it together, at least pieces of this, and then we'll transition into implications for performance. So greater demand for these types of products leads to a higher number of companies who are disclosing this information, as we just heard a bit ago from Jessica. And then Emily's reviewed study here from the Journal of Accounting Studies indicates that the need to disclose might start to change and seems to start to change the behavior of certain companies in this space. So in other words, it's not merely disclosure, it's actually a change of behavior. So then let's take it to the other side of the equation. So imagine that companies are disclosing more, and for many of them, the disclosing actually changes the behavior. But disclosure is expensive, measuring things is expensive, it's time consuming. It might lead to performance, but there's some things that perhaps are worth doing from an environmental standpoint that perhaps don't have short-term types of returns in the market itself. So if we're starting to see disclosure and change of behavior, what does that imply for performance? And I'll just flag someone here in the comments itself. They were kind of asking this question around advice for fiduciaries about how to balance the responsibility for financial performance alongside some of these other pieces. So what do we know about performance? Maybe we start again, Emily, staying with you for a second, and then we'll circle back to Jessica.
I think this is really the crux of the issue for us as investors, is you get all of this information and data. You may have a framework for looking at material ESG issues, but oftentimes there may be a company that, for example, has a very high exposure to water-stressed areas in its operations. And maybe this is a chicken producing company, or maybe it's a fertilizer producer. These are water-intensive activities. It's only if there's a drought, or if there is some kind of conflict with the local community, or maybe there's a regulatory action that increases water prices, where the exposure to the risk materializes. So, and you don't know for sure, like, is it going to be a year, 5 years, 10 years, where that exposure, that risk exposure is going to materialize. So I think there's a lot of buy-in in the investment industry at this point, and the data seems to support in general that looking at ESG factors as an investor is at least a good risk management process. But whether the ESG factor, whichever one you're looking at, climate, water, human capital, whether the ESG factor is the most important factor for the price of that asset at any given time, I don't believe that that's the case. It's one factor among many. And I don't think we look at any factor in the financial markets. We don't look at PE ratio and say that's going to be the cause of the valuation of the company in every market cycle and every quarter for the rest of time. We don't hold any other financial metric to that standard. So I think that we understand, a fuller picture of the company when we look at material factors, material ESG factors. And I think that depending on your time horizon, these factors are more or less likely to materialize. So over a short time period, I think that it's probably not likely, but it's still worth looking at these ESG risks, because you don't want to have a blow up if you're holding fast trading bonds, for example. But if you're looking longer term, so you're kind of a buy and hold investor, there are some insurance companies that buy corporate bonds and hold them to the rest of time. They don't trade them. Or there are some pension funds that are so huge, they have to hold every stock in the market. They're essentially universal owners, and they're going to hold them for a long period of time. It's fairly likely that at some point over the next decade, that factor is going to materialize in some way. And so you are incentivized to talk to the company or to seek better practices in the way that you're assessing companies.
Yeah, that's helpful. Yeah, it's almost thinking back to your framing around regression earlier. We're not going to expect any one factor to explain all the variance in performance, but there would be an interesting kind of exploration of what of the variance is explained by this particular factor versus PE ratio, and starting to understand the differences, which is only done once you actually have that robust data and the kind of analytics to start to explore it. So Jessica, on your end, what are you seeing in terms of performance? How do you think about it conceptually, philosophically, just as we heard there? And are we seeing good studies around how to think about the performance implications relative to cost, for example?
Yeah, and I think this is where Emily used the word materiality, and I think that's super important, right? There are going to be some investors that just want ESG information from a values perspective, right? For them, it's because they need this information because they care about an issue. It's not a financial aspect. But then when we are engaging, when BlackRock's engaging with companies to ask for disclosure, it is grounded in materiality, right? It is about finding what are those data sets that will actually help inform an investor to make a decision. And to the point of that, this is not the end-all be-all data set that investors use. It is one of many data sets. However, for a prudent investor, if you believe that this information can add to your investment process, your investment decision-making, then it is material. So that's really sort of the framing of materiality. It's not that this is the most material, but it is one component of making investment decisions. In general, I would just say that when we do a lot of the research on ESG, we can isolate very key sort of like KPIs, key performance indicators that we believe are material indicators or even potentially just alpha indicators. And we can do this in systematic ways, right? You can constrain a portfolio so that you can sort of mimic the same style factors, sector constraints, all that stuff, but you optimize for kind of one specific aspect of sustainability to kind of see, is that factor itself, is that specific indicator actually making a difference in terms of performance? So you can kind of isolate specific key indicators. And that's a big thing of what we have a central sort of sustainable investing research team. They do a lot of this work where we actually have access to over 8,500 different ESG sustainability related data points in our central sort of portfolio management analytics system. And in searching through all these thousands of KPIs, generally we end up with a couple hundred that we're like, oh, these are actually way more interesting from a materiality perspective. And then from there, you can distill it to like dozens of potential even alpha signals. So for example, one of the signals that has been published many times over is just looking at a company's momentum as it relates to emissions reduction, right? So much of what strategies do right now on climate, on low carbon investing is about where were companies? What have companies done in the past? But if you really want to get alpha, you have to think about what are companies doing in the future? Where are they going? Because a lot of what they've done in the past is already going to be priced in. And so this is where looking at momentum signals, looking at improvement on ESG factors such as emissions intensity is actually becoming very informative to identifying what are the companies that may not be the leaders today, but will become the leaders, and then the market will price that information in. And so if you can kind of get ahead of that trend, that's where we're seeing a lot of the alpha insights being driven from.
That's helpful. That's really helpful. We're gonna transition in a second to critiques of ESG. I think we've started to do a nice job of framing the landscape. But let me just do one follow-up question, perhaps targeting you, Jessica, on this one, but Emily, do weigh in on this. So yesterday we had Cliff Asness come and speak from AQR. And I remember a year ago when I was spending some time at the Koch Center interviewing him for a family office event, I started to read up on some of his critiques of the ESG space. And one of the ones that he did was written in this article called Virtue as Its Own Reward. And he basically makes a case that if you have a hypothetical investor that has access to all the kind of data that you just mentioned, Jessica, including, let's say, momentum or shift of emission standards, for example, and they say, I'm going to screen out companies that don't match these criteria or perhaps tilt towards some that do, versus in contrast, a hypothetical investor that has the same information, but is actually open to investing in some firms that don't have the momentum. So for example, they don't have that. So in other words, they're still open to the positive screened opportunities, but they're also open to the entire hypothetical market, including big tobacco, for example, or the Saudi environmental firms or something. So his argument was that just theoretically, if you have those two investors, one who says, I'm open to all, and then one who says, I'm open to a subset, you wouldn't expect the same kind of returns of the latter versus the former. So with that in mind, I'm curious how the two of you would respond to that critique. What does Cliff get right about this? What does he perhaps miss when thinking about this landscape?
So, I mean, from pure math perspective, I mean, he's right? The more you constrain a universe, then of course, the less sources of alpha, less sources of diversification. Like from pure math perspective, it's hard to argue that a smaller universe will always or will generally perform better than a bigger universe. Now, I think what's different here is that when we talk about ESG integration, it is not about a smaller universe. ESG integration is about the entire universe, and it's about using all data sets. So it's not about screening. It's not about divesting. It's about just using all the information that you have to make the best investment decisions. Now, with sustainable products, I did talk about having some sort of meaningful binding sort of constraint, or just something that is meaningful about the ESG in order to label it different than any other product. And this is where it is about investor choice. It is not to say just because you have some sort of meaningful kind of bind on your strategy, that this strategy in all situations should be underperforming. Really what this means is that you, as an investor, you are choosing this strategy because you yourself have a conviction that that specific approach will perform well in the long term. And so I think the thing with ESG, just like all other data, if the markets were, perfectly efficient, there is no alpha then, right? Everybody had all the sources of data, then everybody should just buy an index and call it a day. So I think the thing is that we know the markets aren't perfectly efficient. We know that there's always information advantage to be had. And we know that society keeps shifting, and that the ways that investors and the ways that even as individuals, the way that we kind of value companies is changing. And so because of that, there is a lot of actually momentum behind sustainable products. This information is getting priced in, but it's probably not fully priced in. And so until that information is fully priced in, then sure. And at that point in time, you could assume the whole world is just sustainable then. But we're still years, maybe decades away from that.
Yeah, that's really, really helpful. So to some degree, it's about more robust information that wasn't there in the past that allows for different types of investment decisions, perhaps to capture some of that alpha. But then there's the second piece, which is saying there can be conviction screen that might not have the same kind of alpha, but is aligned with the actual values of the particular investor, and hopes that it actually drives different behavior in the world, not just in the performance of the portfolio. So I want to shift here. Oh, go ahead, Emily, please. Then we'll shift in a second.
Yeah, but I mean, I think I love what you said, Jessica, about, if the information is fully transparent and it's fully priced in, like in theory, then we wouldn't be having a conversation about ESG. It would just be good investing. It would be just all investing. And I think we're on the way towards that, where this information is priced in and it is absorbed, but it's not perfectly absorbed at all. And we see that all the time. I mean, I think there's also a big difference between saying, here is an index, I'm invested in an index. If you're invested in an index, you're essentially a price taker. You're taking whatever the market is happening in the market. I think that from an ESG perspective, you are then concerned, or you have an incentive to wonder, well, what is the asset manager doing to try to raise the kind of basic standards of behavior across the entire universe so you don't get blow-ups, some recent governance blow-ups that we've had recently in the banking sector, for example. Like, where are investors that are holding every name because they have to, or they're holding an index on that topic? But if you're doing a 40 to 50 stock active strategy, that's a completely different proposition. You are in the business of alpha generation. You are in the business of information asymmetry and monetizing that. You're a price maker, not a price taker. And in terms of price making, I think that there's a lot that investors that are attuned to ESG factors are doing to actually try to precipitate value by working in partnership with the company. So you might see an opportunity that the company doesn't see, because you're attuned to these factors across many different industries and sectors or even countries. And we have constructive conversations with companies all the time about how they are investing their capital for a more resilient, robust future for that company.
Great. Really, really helpful. All right, so let's shift to critiques now. So, and what I really want to do in the second half of our time, because we've got about an hour, maybe a few minutes after for some time, because there's a little bit of a gap there before the next session. But what I want to think about here is themes of critique, and then also what is legitimate, illegitimate about, and how does the particular space respond? So I was doing some reading over the last couple of days in preparation for this, and you can see different articles out there on greenwashing, so in other words, appearing better than you are, green hushing, avoiding disclosure for fear of potential critique, woke capitalism, bad data, understandings or challenges around weighting the E versus the S. I was just reading a piece the other day about Saudi Arabia and talking about the opportunities for real significant progress around environmentalism, and at the same point, some real challenges around human rights on the S side. So there's a lot of ink being spilled, both within the field, within the kind of academic journals that Emily was mentioning, and also out in the Wall Street Journal or the Financial Times or the New York Times. So I'm curious for the two of you, how you see this space of critique, and in particular, which ones you actually say, no, that's something we need to listen to, and which ones you say, you know what, the way that it's talked about here actually kind of misses the mark. So why don't we start with you, Jessica, and then we'll transition Emily in a second over to you.
Yeah, so I think maybe the two that I do think are a bit more legitimate in this space, especially as it relates to sustainable investing, is I do think greenwashing is a real concern. I actually agree with that. And then data. I think at the end of the day, this is all about data. And so while we are eons and eons better, where we are better than a decade ago or even 5 years ago on ESG data, we are still sort of, I would say, miles away from having consistent, standardized, quality, and timely data. I think what's really important to stress about the data front is that this space is evolving so rapidly, right? So there are those standard setters that are coming in and helping to really get us organized on data and really focusing on material data. Like, what is the information that we actually need as investors? There's bodies like the ISSB, the International Sustainability Standards Board. There's bodies like the TCFD, the Task Force on Climate-Related Financial Disclosures. All these organizations are really helping at a global level to actually help corporates sift through the 2,000 different surveys that they're getting of ESG information that they need to disclose on, and helping them figure out what is actually material that you should disclose on to help investors. And so I think that is going to be super important, that we start to move towards international standards where we can actually have consistency of disclosures and quantitative disclosures. So not just boilerplate language, marketing language, but actually numbers. I also think that in relation to these standard setters, regulators are stepping in across the globe. Even in the US, regulators are coming to step in. The SEC had their climate disclosure proposal last March. I know we're still waiting on the final, but it was one of the most comprehensive climate disclosure proposals out there. I think that what we've seen is, in especially regions in Europe, the regulators have all stepped in basically to mandate disclosures, because at the end of the day, it has to start with data. If we don't have the data, then we can't measure, then we can't invest using that information. I also think what's been really interesting in this space is that a lot of the people getting involved in ESG these days, they are quants, they are mathematicians, they are big data folks, because we're actually getting to the point where we have almost too much data. It's just not quality data. And so the jobs of these people now are actually to sift through massive, massive amounts of data and information and actually synthesize it to figure out what is actually important, what is actually material. And then, as I said, one of the issues that we struggle with is also timeliness of data, because a lot of times companies are reporting once a year based off of something that happened 8, 12 months ago. And so there's a huge lag of like when you're getting the information to what point you were measuring the company. And so this is where these big data scientists, and we have many of them here at BlackRock, who are helping us to scrape information in real time. So even when companies themselves aren't reporting the data, we can use different ways to assess them. We can use satellite imagery to actually measure emissions, right? Like we can measure emissions in real time. And so these are the things that I feel like is actually really shifting in the space of data where we are not there yet, but we are getting there. And it's been a really fascinating, interesting journey, I would say. On greenwashing, yeah, I actually do think this is a legitimate concern. And I won't dwell in it too much because I think people kind of understand greenwashing, but I don't think it's that greenwashing has gotten out of control or anything like that. I think what's really happening, though, in this space is that because sustainable investing is becoming more popular, because there are more sustainable products, I actually don't think it's like the percentage of bad apples have increased. I think it's just the total number of bad apples have maybe increased. It's not to say that more people are greenwashing. It's just that there's always been a little bit of confusion in this space, and there continues to be confusion. And just because we have a lot more products, you're just going to see more confusion in the absolute terms. But this is, again, where I would say regulators are kind of stepping in again. The SEC is coming in with their ESG disclosure proposal, their names rule. And at the end of the day, I do think this is, the role of the asset manager is to be transparent. You need to be clear on the design of your strategies. You need to explain how your ESG data is being used in these products. You need to report on ESG data for these products. And that's how investors can then make informed decision on which strategies are right for them. And I think the thing is, it all goes back to investor motivations, right? An investor could buy something like a clean energy fund because they want to actually help further advance the net zero transition. The same investor could buy, or a different investor could buy that same fund because they believe that there's a growth opportunity, right? So it doesn't mean that this one product only fits the needs of one client, but we just need to be clear about what is this fund investing in, how is it using ESG information, and then disclose on those things.
Yeah, that's great. Let me do one follow-up question, and then let's turn it over to hear, Emily, your response on this. So it's easy to think of the investor as singular. So Peter is an investor. He's deciding for his family how he's going to approach investing. And then there's the complicated pieces when the investor is not singular, but let's say, for example, they're a part of the Chicago Teachers Union or CalPERS or something else, when they are represented as an investor, but it's thousands, hundreds of thousands of people that are actually being done singular that have varying different motivations in terms of how they think about the prioritization of A versus B, or whether A and B matter at all. Mm-hmm. So as you think about moving that out from a singular investor and their own motivations to guide either the way they think about investment or perhaps the way that they weight certain criteria over time, to this broader question now of a homogenous investor group that is representing a fractured set of interests across people, does that become more complicated? It feels like where maybe some of the woke capitalism or critiques about how this fund is investing in different products come in to some degree.
So I still think, when we talk about investors, whether individual or institutional type investors, there's still three foundational motivations, right? I think this is what I talked about earlier, is that you choose these products, or you believe in ESG information because you believe it enhances returns. You're doing it because there's mission alignment, because some of these institutions do have missions. Or third, you're doing it because you want to contribute to some sort of sustainable outcome. I think what is different with a institution is that they are kind of bound by their investment policy statement, right? They actually have to make a statement about what it is that they believe in, how they will be investing, and they have to be transparent about it. And then they, of course, also have their board. And this is where I think there's actually a fourth motivation for institutional investors, where sometimes their practice on sustainability can be mandate driven. So for example, some of these asset owners are actually setting net zero ambitions. And it's not so much that it's always the investment team making these decisions, but it could be the board saying, we as a corporation believe in this. You now have to implement it also on the pension side, on the foundation side, based, on the just the corpus side. And so I do think that when they make those statements, though, then you have to reflect it into the investment policy statement, and that becomes sort of your source of truth for how you invest.
Helpful. And Emily, what about for you? So we're talking about these various different critiques. What do you hear and you say, gosh, I need to think about that a little bit further? That's a really good point. And where do you say, no, that's actually a little bit less legitimate, misunderstands the space?
Well, just to kind of follow on from Jessica's final comment, and I'll get to the critiques. When we're speaking to large institutional investors, there's actually quite a process of figuring out alignment. What is the largest institutional investors who I think are doing the most thorough job of this as a fiduciary of their ultimate beneficiaries' assets are the ones that have thought deeply about it at the board level, and they have incorporated an ESG policy into their investment policy statement. That enables them to have a discussion with their service providers, with asset managers, about where do you align? Do you align with the way that we think about it? Or do you have the flexibility to provide products that are oriented towards this philosophy? So again, it's the investor choice around it, and the ability to be flexible to meet that the space is focused on. And on the critiques, I mean, I think Jessica did a fantastic job of summarizing what's going on in the data space, the poor data, there isn't enough data. That's a critique, but that's not a very constructive critique if you don't then roll your sleeves up and actually try and fix the data issue. And I think we're on the cusp of, over the next few years, having the ISSB standards, so the International Sustainability Standards Board, operating under the auspices of the IFRS, is doing a fantastic job of consulting with industry investors globally to roll out a standard set of proposed disclosure metrics that the Hong Kong Exchange, just overnight, I read a headline that the Hong Kong Exchange is now having a consultation about making some of those metrics mandatory for companies in their jurisdiction. And it'll be followed by, I think, similar moves in other APAC jurisdictions like Australia and Singapore. So I think we're on the cusp of trying to get closer to solving the data issue. In my mind, the greenwashing versus anti-ESG or anti-work capitalism kind of critiques, in my mind, they're actually anchored in the same underlying problem, which is that definitions haven't been clear. Asset managers have peddled a little bit of confusion themselves between values and value and which side are you on, or what is this product actually achieving. Doing perhaps some great ESG integration, but then slapping an ESG label on the product, which, as Jessica mentioned earlier, at her firm, you wouldn't call it an ESG product if all you're doing is it might be robust consideration of the factors, but you don't actually have a floor of ESG performance that you expect to see in the companies that you invest in. You don't have an orientation towards those outcomes. That's not an ESG product. So in the lack of clear definitions and in some of this kind of behavior that's been fudging between different motivations to try and maybe appeal to as broad an audience as possible, you've had a huge monetization of the space that's been confusing. And so then that's ripe for critique from people saying, well, you are using this data, you're using these ideas as a political kind of ploy for unelected officials to start to make policy decisions that are actually the province of governments. I mean, arguably, if you can't articulate what you're actually doing, maybe that's a fair critique. But if on the other hand, you're kind of slapping a label on it, but you don't have the compliance systems in place, you don't have the documentation, you don't have the investment policy that's underpinned by your own research, quantitative or qualitative, about materiality of ESG factors, then it is greenwashing. And it's actually the same problem, just manifested as a different strain of critique from different parts of the universe. That's how I see it.
That's really helpful. And I appreciate that. Let me stay with the data for a little bit. So I want to imagine a future where data is transparent, it's in real time, the cost of acquiring it is lower. So imagine some sort of beautiful future when we don't have to wait for annual compliance disclosures around emissions, for example, but we use information around the photos, as we heard just a bit ago from Jessica, to actually see this. But I want to go beyond data, because data oftentimes implies some sort of judgment. So, for example, back to the Saudi Arabia story that I just gave a short bit. It's one thing to say that we have perfect data on each of these ESG factors. It's another thing to think about how we weight one category versus another, whether one is more important than another. And so I guess my question is, to what extent do firms like the two of you represent have to play a role in suggesting weightings or suggesting how factor A compares to factor B? Or to what extent is it just merely about the product integrity, that we're going to put out information about all these things, but you as an investor have to make a call about, for example, whether human rights or environmental impact is more important for you across your portfolio? So from data to judgment to some degree.
I think it's a great question, Peter. I think that if you are an active manager, as we are, you're inherently making judgments about things all the time. We're making judgments about the potential for conflict in the Taiwan Strait. We're making judgments about the potential for inflation to be responsive or not responsive to the latest interest rate increase. Similarly, we're making judgments about what factors we actually think in the universe of ESG factors available to us are the most material, which ones are universally material across all industries. So for example, at Calvert, we think of diversity as a material issue across all industries, whereas some factors are really, really very specific, such as water scarcity and water stress management is going to be very material to water intensive industries like
your chicken farm example from earlier, right? The chicken farm.
Or semiconductors manufacturing is one that, because it takes gallons and gallons of water to create one tiny chip. So obviously that's going to be material to you. So I think that it is our role to make those judgment calls, and I think that's, as an end client of an investment product, that's what you're buying. You're buying the quality of the judgments made. So at Calvert, the way we have approached this is having a centralized specialist ESG research team organized by sector experts who know those industries really well, know the companies in those industries, and are experts in being able to explain which ESG factors are most relevant and why. And they track where it hits company financials. And what we do in order to kind of balance the E, the S, and the G is we have research models that essentially bring in factors, ESG data from various vendors, piped into a centralized system, put into a standardized format so it's malleable and we can use it. And we essentially use those factors to build proprietary models that allow us to benchmark companies in a given industry on the same factors. That's relevant because they're all in the same industry and we're not comparing apples to oranges. And that benchmarking allows us to more quickly identify the companies at greater risk because they don't apparently seem to be actively managing the issues, and the companies that are leaders. And those models, we pay attention to them and we update them on a periodic basis because the world moves. So a couple of years ago, what was particularly important was the response to COVID. And today, in an era of, knock on wood, post-COVID or post-pandemic, those issues are different. So supply chain's been really, really important the last couple of years. Today, it's more energy crisis and energy costs, more so than supply chain in some cases. Supply chain is still an issue, obviously, but in some cases.
So let me play this back to you, Emily, and then Jessica, I'd be curious your take on this as well. So is it fair to say that judgment is always occurring? That's part of why they're going to Calvert, for example. But what's especially important is being explicit about the assumptions behind that judgment to say, here's what guides our approach so that there can be dialogue around whether or not those are legitimate assumptions or fair ways to approach it. Is that part of the transparency story? Is not just on the data itself, but also around criteria of judgment?
Yes, absolutely. Yeah. And I think that's why as a client of investment products, you should expect to be able to engage with your service provider on what is your ESG philosophy, explain how you approach it. And you might not fully agree on every single element, but if you broadly feel that there's alignment, then it's a good partner to work with. If the asset manager can't explain, this is the philosophy as a house, and that applies across all of our products, or as Jessica mentioned, for this one product, the philosophy is this and the objective is this. If they're not sufficiently transparent with you, I'm not sure how you'll ever be able to figure out if it's the right product for you.
Yeah.
Jessica, same framing. How do you think about the judgment piece?
No, I mean, everything Emily said, I completely agree with, and it's very similar to the approaches that we take at BlackRock, where we don't really have like one team only that kind of does all of the sustainability work. Since we have a lot of different investment teams across the globe, we do have a central sustainability research function that helps to feed. But at the end of the day, portfolio managers make the decisions for their own portfolios. I do think what is really important here, though, is that the space of ESG integration is also evolving rapidly, right? Like 10 years ago, I would say a lot of asset managers weren't really integrating ESG information. Today, they are. And today, it's getting much more sophisticated. So even the client conversations, the assumption is that asset managers are integrating. It's table stakes now. The questions now are just getting more complex and more, I would say, sophisticated from the clients themselves, where it's not just tell me what your ESG integration statement is, what is your policy, but it's like diving into the actual examples of tell me why you chose this company. Tell me what information you used to actually decide to overweight this name. What made you decide not to invest in this name? And these are the examples that investors or clients are asking of us now to really understand how ESG information actually shapes some of the investment decision making that we do. So I do think that transparency is really, really important. That's something that across the firm, we've been working with the investment teams to make sure that not only do they have their statements or policies, but that they actually have these examples of explaining how that ESG information actually manifests in their investment decision making. And then I think separate from process and integration is the products, right? And this is where products can be tailored for specific things. There can be a DEI strategy that completely ignores climate and just focuses on DEI metrics. As long as you're transparent about that, then that's fine, because there are going to be some investors who primarily focused on diversity, and what they want to do is invest in a DEI strategy. Other investors are going to care a lot about climate, and all they're going to care about are climate data sets. And so you can structure strategies to kind of lean into specific data sets, but that's also where product level transparency becomes really important.
That's great. We're going to spend just a few minutes here, maybe covering the future, and then we'll close it off. I'll keep my eye on the questions as well. So if the two of you will also just kind of open up the Q&A, see if there's anything interesting you want to address. But I want to just do one follow-up question about this space. So it feels like progress to me to some degree. Think of this as ESG 2.0 or 5.0 or 10.0, whatever number we're at. Some portion of it is really on you all and or the regulating bodies to have further transparency, better data, etc. It also seems to imply that you need to have the investor who knows how to think about these things well. So imagine all of a sudden I get to a meeting and I'm plowed with a bunch of information, more data than ever, but I might feel overwhelmed. I'm thinking of, for example, my parents sitting in an investment decision, let alone others who maybe don't have the right way to think about it and therefore are overwhelmed by the information. So how do we make progress on that front? How does the everyday individual or institutional investor with better data, with further transparency, with more of these models made explicit, how do they actually make better judgment calls when it comes to this space?
Honestly, I think it's just experience, right? When we started on our ESG integration journey years and years ago, right, in the beginning, a lot of it was testing. A lot of times what we actually had investment teams do were they were actually starting to run shadow or model portfolios, modeling some of this data out. So they weren't actually using it on day one to actually influence their decision making, but they were tracking it over time. And then over time, as they became much more comfortable and actually more experts on the data and actually had conviction in the data, that's when they really used that information and sort of influenced their investment decision making. So I do think for a lot of investors out there that are just starting and thinking about using this data, it's one of those things that you need to build your own conviction in. Every portfolio manager needs their own conviction on what data sets are right for them, what data sets are right for their asset class, for their investment style. In some ways, quants and systematic investors have it a lot easier. Fundamental investors really need to actually dig into the fundamental due diligence of the companies and actually figure out for each company, what do they really believe in and where do they have that conviction? So, from what we're seeing, it really is about making sure that investors themselves have that experience. And I think that's why at BlackRock, one of the things that we've done to be successful, or to actually, I would say, to be somewhat successful in the ESG integration space, is that we're not trying to parachute ESG analysts who have no investment expertise in the sector to make ESG information or ESG decisions for the portfolio manager. At the end of the day, it has to be the asset class specialist, has to be the sector specialist who has that conviction, who knows that industry, who knows that asset class very well, in order to really actually integrate ESG into the investment process. So I think that's the other thing that's really important.
Yeah. Great. Well, let me do one final pivot on this. And maybe this will be kind of some of the way that we close out our time over the last 5 minutes or so. But I want to imagine for the two of you now, thinking about the future of this space. So imagine you're sitting here and you're trying to task your teams with how to think about where they should invest their time and attention, ways that they should think about evolving your own company's approach to this work moving forward. What's the best ROI of their time? Where are there areas where this space really does need to evolve? Again, forget about the policy standpoint for a second. Maybe we can circle back to that at the end. But really, in terms of the way that Calvert or BlackRock enters into the space, where is there a need for evolution, and where should your teams be spending their time? Emily, why don't we start with you on this one?
Well, I think there's a few areas. So one is that, and I think we've implicitly mentioned this, but the need to be able to customize your strategy for the needs of the customer, which is for the investment beliefs of the customer, because we are seeing more and more sophisticated queries come to us, particularly from public pension funds, from family offices that have a particular interest in a particular ESG theme or have conviction in how important that theme is, particularly around climate, for example, or some environmental themes, that they want to actually allocate a meaningful amount of capital to that theme. I think the ability to customize your existing product set is important for us. And I think that reflects a broader move towards customization of all types in the asset management space. I don't think that's only specific to ESG.
And Emily, let me just pause you there for 1 second, because I love this point. So imagine right now, if someone's working with Calvert, customization looks like X, but 5 years from now, I'd love to make it look like Y. How would you see that evolution?
Well, I mean, for example, we partner with our sister company, Parametric, to have a core Calvert equities portfolio. It's a US equities portfolio, and they specialize in responding to specific client requests about take this company out because I don't like them, or I want to take this, but I want to tilt it more towards this particular industry for whatever reason. These are clients that have very specific views about the markets that they would like to see expressed in their strategies. So we partner with them on that type of implementation, or it could be a large institutional client that, for example, likes our approach to decarbonization in the way that we invest, but needs the way that we construct the portfolio to have a particular, again, tilt towards a country or region, which is different from a fund that we may have off the shelf. So that type of customization, you've got to have, I think, the core intellectual capital or intellectual property assets to be able to do that well. But then the ability to pivot is a next layer of capability that I think that in the industry is an area of growth. I think the other area of growth is compliance and documentation and tracking systems, and having, Jessica mentioned the data specialists on her side. And there's incredible need for people that have quantitative skills, coding skills, to move into this space, to basically take data that, comes from manually comes from company reports, get it into an industrial grade system for thousands of companies, mapped across both equities and fixed income security identifiers, which are not the same, but the mapping that allows you to look at this ESG factor in relation to a particular instrument. For a particular strategy. I think, the ability to build those data systems and then to build fund or portfolio surveillance against those systems is a huge area of growth in the industry right now. And it's in direct response to, I think, some of the critiques that we have been that we discussed earlier.
Yeah, it's a great framing. So Jessica, you're entering to this new role, right? You got a new title, you're updating your LinkedIn, all these different types of things. I'm sure you're thinking about the next 3 to 5 years, at the very least in the product integrity space and probably beyond. So where are you going to allocate your team's time and attention? What should they be working on to make this space a better version of what it is now?
So I think there's always work to be done on improving governance standards and everything on broad sustainability. But right now, I feel like the topic du jour is climate and transition. And that's really where my team is spending a lot of our time on, is trying to define what is a climate transition product? How do we look at data? How do we build strategies around this? And I do really feel like this is a real shift that we're seeing in client interest, where years past, it was always about broad ESG, broad sustainability. But over the past 3-4 years, the number of client conversations that we have on climate is just increasing so much. And there are a lot of investors out there that don't actually care about broad sustainability, but they only care about climate. And so from that perspective, when I think about integrity, innovation, the climate space is probably the area that I know my team will be spending a lot of time on. And when I think about the innovation in this space, it's actually both on the transition to net zero. So it's about how do we mitigate the emissions so that we can get to a more sustainable economy. But it's actually also about resilience and adaptation. And so like when we think about the new themes that are emerging and what's getting really interesting in this space is that as there's becoming more recognition that it's unlikely that we could hit a 1.5 degree scenario, that the Earth is already warming and it's likely to continue to keep warming, we're going to be more exposed to extreme weather events. So how are we going to invest in the technologies and solutions to adapt to that world? Because that is actually also a huge growth opportunity. And when we think about the transition itself being underfunded, resilience and adaptation is even more underfunded. And so there's actually a lot of opportunity right now to get early into that space and to actually find some of those companies that are developing those technologies, those solutions to build a more resilient society. And I think when I think about innovation in the product space, it's going to be a lot all around climate.
Yeah, that's great. Well, I want to thank the two of you for weighing in on this. There were a bunch of really great questions that I did my best to at least hit a few of them over time. But if you're looking to learn more, I really would encourage you to take a look broadly at some of the things that are being raised. There's even a reference to a newsletter that might be worth reading. But for the two of you, I really appreciate this discussion. I think your ability to frame the importance of data, transparency around data, the need to acknowledge the fact that there's always a level of judgment being taken place in the midst of these portfolio designs and product design. And so being transparent about that is a theme that came across to me. I think also to have some clarity around how do we think about performance. Performance could be a change of actual financial performance of the portfolio. It could be change of company behavior. So at least for me, as I was prepping for this and spending some time with you, I found your comments really helpful for framing a space that is pretty amorphous in terms of how people are talking about this in the broader literature. So again, as the two of you continue to do your work, again, many thanks for all the stuff that you do. I wish you best in the next 5 years of your own development of your own company strategy moving forward. And with that said, I will turn it over to Ed here shortly. But again, thank you to both the two of you for all the time.
Thank you so much for having us.
Thank you, Peter.
Thanks, Emily. Thanks, Jessica.
Absolutely. Thank you, Peter, Jessica, and Emily. That was an incredible conversation about ESG.